Same age, same income, same $50,000. Ryan puts it into real estate, Derek puts it into Bitcoin. From this exact moment, we're going to track every dollar that goes in, every dollar that comes out, every hidden cost, every tax bill, every surprise expense, and every hour of their lives each asset demands. No narratives, no hype, just the real numbers side by side over 20 years. Let's keep this fair. Ryan and Derek both have $50,000 saved. Same age, same city, same salary, $80,000 a year. The only difference is what they do with that 50 grand. Ryan uses it as a 20% down payment on a $250,000 rental property, a solid 3-bedroom in a decent neighborhood. He takes out a 30-year fixed mortgage at 7% interest on the remaining $200,000. His monthly payment lands at about $1,663. That's principal and interest combined. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $137 a month in profit before he spent a single dollar on anything else. Ryan still feels like he made the right move. Derek takes his $50,000 and splits it across a few positions. He buys spot Bitcoin directly from a reputable exchange, picks up a spot Bitcoin ETF through his brokerage for cleaner exposure inside his existing accounts, and takes a small position in a Bitcoin treasury company. Think MicroStrategy, Strive, or Metaplanet. Stocks built around holding Bitcoin as their core asset. He's not putting it all in one basket, but make no mistake, every basket is pointed in the same direction. No mortgage, no tenants, no phone calls at 2 a.m. about a broken pipe. But here's the part most comparisons completely skip. Ryan is paying $1,663 every single month toward his mortgage. That money is leaving his account whether he likes it or not. Derek commits to the same discipline. Every month, the same $1,663 that would have gone toward a mortgage goes into his Bitcoin position instead. Spot purchases, ETF contributions, treasury stock allocations. Same dollar amount, same monthly commitment, same 20-year timeline. The only difference is what that money is buying. Derek checks his portfolio more than he probably should and tries very hard to do nothing. Same money, same starting line, same monthly commitment. Completely different bets. For the first couple of years, Derek looks like an absolute visionary. Bitcoin is surging. The halving cycle, macroeconomic uncertainty, global instability. In a single year, Bitcoin jumps 60, 80, maybe 100%. Derek's $50,000 is suddenly worth $90,000. Bitcoin is still very volatile, but he didn't fix a toilet. He didn't screen a tenant. He didn't answer a single phone call. He just sat there and watched his net worth climb. Meanwhile, Ryan is living in a different reality. His first tenant trashes the kitchen and moves out after 8 months. It takes Ryan 6 weeks to find a replacement. That's 6 weeks of zero rent. But the mortgage doesn't stop. Neither do the property taxes, the insurance, or the $3,200 HVAC repair that hits in month 4. When you add it all up, mortgage, taxes, insurance, maintenance, vacancy, Ryan's actual cash flow in year 1 is deeply negative. He's losing money every single month. Derek's phone hasn't buzzed once about a broken pipe. His Bitcoin position is up significantly. He's starting to feel a little sorry for Ryan. But the price of simplicity has a fine print. Bitcoin produces no traditional income. No rent, no dividends in the classical sense, no interest. The base asset just sits there, and the only way the core position makes money is if the price goes up. If it doesn't, you earn nothing, while inflation quietly chips away at your purchasing power. That's the honest math of holding spot Bitcoin. And Bitcoin doesn't always go up. After its peak in late 2021, Bitcoin lost over 75% of its value by the end of 2022. If Derek had bought near that high, his $50,000 would have dropped to around $12,500. Not underperformed, lost value. Real money, gone. And unlike a house, there's no tenant paying down the debt while he waits for a recovery. He just sits with the loss and keeps making his monthly contributions. That monthly discipline is actually his biggest advantage during a downturn. He's buying more Bitcoin at lower prices every single month. Dollar cost averaging doesn't eliminate the pain, but it quietly turns the crash into an accumulation opportunity. Bitcoin's volatility isn't a feature you can accept in theory and then breeze through in practice. It's a psychological grind. When your investment drops 40% in a month, the average person doesn't hold. They panic, they sell, they stop the monthly contributions, they lock in the loss, and walk away from the best buying opportunity of the cycle. The people who made fortunes in Bitcoin are the ones who had the discipline to keep buying through 3 or 4 complete gut punches. Most people don't. Most people aren't those people, and they find out the hard way. But here's where Derek's approach is different, and where the Bitcoin ecosystem has quietly been evolving. Derek isn't just holding spot Bitcoin and staring at a price chart. His position in Bitcoin treasury companies like MicroStrategy, Strive, and Metaplanet exposes him to something genuinely new. These companies are pioneering preferred equity instruments, structured financial products that pay monthly and even daily dividends to investors, backed by their Bitcoin holdings. It's not a savings account, it's not a bond, but it beats leaving cash in a bank earning next to nothing. And it gives Bitcoin-aligned investors a way to generate yield without ever touching their core holdings. Is it traditional? No, but finance has always evolved. And right now, there are enough Bitcoin-native financial products emerging, ETFs, treasury stocks, yield instruments, structured notes, that if you look hard enough, you'll find a flavor that fits what you actually want. The ecosystem is building the tools in real time. There's still the tax reality. The IRS treats Bitcoin as property. Every sale is a taxable event. Short-term gains are taxed as ordinary income, up to 37%. Long-term, 15 to 20%. The monthly contributions create multiple cost-basis lots to track. The complexity alone is enough to give an accountant a headache. Derek's mindset is built around one simple rule. He only invested what he never wants to sell. The Bitcoin he holds on the exchange and in the ETF isn't money he needs next year or the year after. It's a long-term allocation he treats the same way you treat property. You buy it, you hold it, and you don't panic when the market gets loud. He keeps enough cash on the sidelines to weather any Bitcoin storm. If the price drops 50%, he doesn't have to sell. He just keeps buying. That changes everything about how you experience the volatility. Now let's talk about Ryan's side. Let's talk about that $137 a month. Ryan ran the numbers on a napkin, and it looked great. But napkins don't include property taxes. They don't include insurance. They don't include the months where the unit sits empty and the mortgage still comes due. They don't include the roof, the HVAC, the tenant who stops paying and takes 3 months and a lawyer to remove. Here's what the real number looks like. Mortgage, $1,663. Taxes, $250. Insurance, $120. Maintenance, $210 to $420 a month when you average it out. Vacancy, 1 month a year of zero income, which works out to about $150 a month amortized. Property management if he outsources it, another $150 to $180. Real monthly cost, $2,400 to $2,800. Real monthly income, $1,800. Ryan is hundreds of dollars in the red before a single thing goes wrong. And something always goes wrong. If Ryan cuts costs by self-managing, he's not passive. He's on call. He's the maintenance department, the leasing office, and the collections team. That time has a dollar value. And when you calculate it honestly, real estate stops looking like an investment and starts looking like a second job. By year 5, something starts to shift on both sides. Bitcoin's surge cools off. This is historically normal. Bitcoin moves in violent cycles, massive runs followed by multi-year consolidations. After the euphoria fades, the price can grind sideways or drop for years. Derek's portfolio, which looked brilliant at the peak, may have pulled back significantly. His treasury stock positions are down too, moving with sentiment. The Bitcoin Treasury Company preferred stocks he holds are consistently paying their dividends though, and that steady income is something he's genuinely happy about, a quiet return while everything else is noisy. He checks the price less than he used to. He's learning patience the hard way. But every month, that $1,663 is still going in, quietly accumulating, averaging down through the noise. Ryan, on the other hand, is grinding, and the numbers are slowly turning in his favor. Rent doesn't stay flat. It tends to rise with inflation, roughly 3 to 4% a year. By year 5, Ryan's tenant is paying about $2,100 a month. By year 10, closer to $2,450. But his mortgage payment? Fixed. The same $1,663 it was on day 1. That gap between rent and his fixed costs keeps widening in his favor. The property appreciates too. At a conservative 3.5% annual rate, Ryan's $250,000 house is worth about $297,000 by year 5, and roughly $353,000 by year 10. Ryan still gets the calls, still deals with repairs, still handles turnover, but the math is no longer underwater. He's edging into cash flow positive territory, and his net worth is climbing steadily. Derek isn't watching the price anymore. He's watching the pattern. Every cycle that came before this one ended the same way, higher than where it started. He has no reason to believe this one is different. The $1,663 going in every month during the quiet years is the move most people are too impatient to make. Now let's zoom out and run the full 20-year numbers. And this time, we're counting every dollar both of them put in, not just the opening $50,000. Ryan's property, appreciating at 3.5% per year for 20 years, is now worth approximately $497,000. His mortgage balance after 20 years of payments is down to about $143,000. That means Ryan has roughly $354,000 in equity in a property he bought with $50,000 down and $1,663 a month for 20 years. On top of that, Ryan's been generating positive cash flow for the last several years. But let's be honest about what that actually adds up to. He didn't turn cash flow positive until around year 9 or 10, when rising rent finally cleared his real costs. From that point through year 20, his net positive cash flow averaged maybe $200 to $400 a month. That's roughly 11 years times 12 months times an average of $300, about $40,000 in cumulative net rental income after every cost is accounted for. Total position, roughly $390,000 to $400,000 in combined equity and cash flow. Over 20 years, Ryan put in $50,000 upfront and $1,663 a month, about $399,000 in total mortgage payments alone, not counting taxes, insurance, repairs, and management fees. His all-in cost over 2 decades is closer to $550,000 to $600,000 when you count everything. His ending position means Ryan, in pure dollar in, dollar out terms, didn't make money. He lost ground. His real return came entirely from leverage and forced equity, not cash profit. Now, Derek. Derek put in $50,000 up front and $1,663 every month for 20 years, $399,000 in total contributions. All in, about $449,000 in capital deployed. No repair bills, no vacancy losses, no management fees. Every dollar went directly into the asset. Realistic. Bitcoin averages 20% annually, a figure grounded in its historical 4-year cycle performance as institutional adoption deepens and sovereign allocation grows. The $50,000 lump sum grows to roughly $1,917,000. The $1,663 monthly contributions, compounding at 20% over 20 years, grow to approximately $5,172,000. Combined pre-tax position, roughly $7,089,000. After long-term capital gains tax, somewhere around $5,761,000. Derek has roughly 15 times Ryan's outcome, with no repair bills, no vacancy losses, no management fees, and full liquidity the entire time. Optimistic. Bitcoin averages 30% annually, the kind of return its early cycles produced, driven by a world where Bitcoin becomes a global reserve asset and sovereign treasuries hold it alongside gold. The numbers at that point become almost difficult to say out loud. The $50,000 lump sum alone grows to over $9,500,000. The monthly contributions compound into territory that makes the real estate comparison irrelevant, well over $24 million. Total combined, north of $34 million. This isn't the base case, but it's not impossible either. And that asymmetry, the fact that it's even on the table, is something no rental property can offer. And there's one more framework worth understanding here. Bitcoin follows what researchers call a power law, a mathematical relationship between price and time that is held remarkably consistent since Bitcoin's earliest days. The model suggests that Bitcoin's price doesn't grow randomly. It grows along a predictable curve, with price floors rising over time regardless of the volatility above them. Every cycle makes a lower low that is still higher than the previous cycle's high. If the power law holds over the next 20 years, and it has held across every order of magnitude Bitcoin has climbed so far, the long-term trajectory isn't a guess, it's a pattern. Not a guarantee, but a pattern that doesn't care about the headlines, the bans, the crashes, or the skeptics. It just keeps doing what it has always done. Even in the realistic scenario, Derek wins, and it's not particularly close once you account for what Ryan actually spent to get his number. Now, let's be fair to Ryan's side one more time. Real estate deserves credit where it's due. The leverage alone is something Bitcoin can't touch without introducing a whole new layer of risk. Ryan controlled a $250,000 asset with $50,000. 5 to 1. The bank took on the risk while Ryan captured the upside. And that leverage is the single biggest reason real estate has built more generational wealth than almost any other asset class in history. Not because the returns are spectacular, because the structure is. Real estate is also stable in a way Bitcoin simply isn't. Ryan's property didn't lose half its value because a tweet went viral. It didn't drop 40% because a regulator made an ambiguous statement. The floor is visible. The walls are literal. And for most people, that tangibility matters more than they'd like to admit. And there's a psychological argument too. The best investment is the one you actually hold. For someone who would panic sell Bitcoin at the bottom, real estate's forced illiquidity is a feature. You can't sell a house at 3 a.m. in a moment of fear. That friction has saved more portfolios than any investment strategy ever written. But here's where Derek's approach has one more structural edge. Ryan's $1,663 a month is an obligation. If he loses his job, gets sick, or hits a financial crisis, that mortgage still comes due. The bank doesn't care. Miss enough payments and he loses the asset entirely, along with every dollar of equity he built. His monthly commitment is a liability until the day it's paid off. Derek's $1,663 a month is a choice. If he loses his job, he stops contributing. The Bitcoin he already owns stays exactly where it is. His downside is a pause in accumulation, not a foreclosure. That asymmetry, obligation versus choice, is one of the most underrated differences between these two assets. Neither Ryan nor Derek was wrong about what they chose. They were wrong about treating it as the only choice. Ryan went all in on a single, illiquid asset that demanded his time, his money, and his patience every single month for 2 decades. He got leverage, equity, and a tangible asset, but he paid for every dollar of it, in cash, in hours, and in headaches that never showed up on any spreadsheet. Derek built a Bitcoin native position, spot holdings, ETF exposure, treasury equity backed by Bitcoin with dividend and yield instruments that paid him along the way, and the same monthly discipline Ryan had, and treated it like what it actually is, a digital asset class that rewards long horizon holders who never invest more than they're willing to hold through a storm. His edge wasn't a better entry point. It wasn't perfect timing. It was his mindset and his consistency. The real trap isn't Bitcoin or real estate. It's looking at the sticker price and thinking that's what either one actually costs you. Ryan didn't buy a $250,000 house. He bought a $250,000 house plus 20 years of his life. Derek didn't just buy $50,000 of Bitcoin. He spent months understanding what he was actually buying before he put in a single dollar. He read the white paper, he studied the halving cycles, he understood the fixed supply, the network effects, the regulatory landscape, the global monetary liquidity cycles, and the risks. He did the work that most people skip because they're in a hurry to get in. And that research is the only reason he had the conviction to hold when everything was red, to keep contributing when the headlines were brutal, and to not flinch when everyone around him thought he was wrong. Conviction built on research doesn't feel like hope, it feels like patience. And patience compounded over 20 years is worth millions. That's the real cost of ownership, and only one of them got the better deal. If this video made you think differently about what your money is actually doing, hit the like and subscribe button.